Hello and welcome to another Cotton Incorporated podcast. My name is John Devine, economist with Cotton Incorporated. In the previous episode, we discussed preliminary supply and demand forecasts for the upcoming 2011-2012 crop year. Early in the spring, at the time of that episode, we were focused on how cotton growers around the world might respond to record cotton prices experienced throughout 2010-2011. High prices tend to motivate additional cotton acreage and therefore can lead to higher levels of cotton production. In response to the high prices in 2010-2011, it is expected there will be a record harvest in 2011-2012. However, the latest estimates from the USDA suggest that the world cotton harvest will be about 3 million bales smaller than was initially forecast in February. Some of the reduction to the world production forecast comes from adverse growing conditions in important cotton growing countries like the U.S. Even with slightly lower projections for the upcoming harvest, current estimates suggest that the 2011-2012 crop will be about 9% larger than the one in 2010-2011 and will be 2 to 3% larger than the previous all-time record set in 2006-2007. There is still time for the weather to help or hurt cotton harvests, and uncertainty persists on the supply side of the cotton balance sheet. While uncertainty related to the eventual size of the cotton harvest will likely influence move cotton prices in coming months, the demand side of the balance sheet also poses important questions to the cotton market. This episode explores some of these demand-related questions and discusses potential implications for prices. In virtually any market, demand can be seen as a product of two primary factors. One, how many customers you have, and two, how much money each customer spends. In the context of highly globalized commodity markets, the number of customers is essentially the world's population. Representing how much each person in the world is spending on a given commodity is somewhat more complicated. But a potential way to represent ability to purchase commodities is to look at world GDP per capita. The world's population continues to grow, meaning that there are more potential consumers of commodities. Over the past 15 years, the world's population has grown at an average annual rate of about 1.4%. This may not sound like a lot, but it implies that the world population has grown by more than 20% since 1996. That means that for every 5 people that were alive in 1996, there are 6 people that are alive in 2011. The world's population is expected to surpass 7 billion people within the next 5 years. Over the last 50 years, the growth in the world's population was accompanied by dramatic growth in the world's economy. Since 1996, world GDP grew just over 50%. Even with the growth in world population, the strength of economic growth brought world GDP per capita from levels below $5,000 per person in 1996 to levels above $6,000 per person in 2011. Recent economic growth has been concentrated in emerging markets, where much of the world's population is located. Economic growth in these countries has enabled many to make more and different purchases than they were able to do just a couple years ago. It effectively has shifted millions from subsistence-type livelihoods into the world's consumer class. With many of the world's newest consumers transitioning from subsistence-type livelihoods, among the first things that they're buying with their additional income is more energy and more food to make their lives more comfortable. This has increased demand for a range of commodities and put pressure on commodity prices. In terms of crop year averages, oil prices thus far into 2010-2011 are about 3 times their level 15 years ago. Over the same time period, corn prices have doubled. In addition to more energy and more food, the world's new consumers are also buying more clothing and textiles. And although the largest increases in cotton prices were lagged relative to the increases in prices for oil and corn, demand resulting from there being more people with more money throughout the world was a contributor to the strong increases in cotton prices we have seen throughout 2010-2011. On average, cotton prices this crop year are about twice their level in 1996-1997. While the rising tide of demand, brought about by a larger, more prosperous world population, was a factor in bringing cotton prices higher this crop year, a sharp weakening in demand over the last couple months has been widely credited with bringing prices lower. An important question relative to the future direction of prices is, why did demand decrease over the past couple months? One possible answer is demand destruction. Demand destruction is an economic term that implies that demand is destroyed or shifted lower when prices move higher. In the context of the cotton market, demand destruction could occur if there were a major shift away from cotton to competing fibers, or if consumer demand at retail fell sharply in response to higher apparel prices. While it can be assumed that some fiber substitution is taking place, anecdotal evidence has been mixed, and it will still be several months until sufficient data are available to accurately answer questions regarding the extent to which cotton's market share may or may not have been damaged. Further complicating the question of demand destruction relates to apparel prices. Higher prices have yet to surface at retail, and year-over-year sales figures remain positive. U.S. consumer spending on clothing was up nearly 6% year-over-year in the first quarter. Chinese retail sales figures, which have become increasingly important to the world market, continue to post double-digit year-over-year gains. With higher retail prices expected to surface in coming months, there may be some expectations by retailers and brands that there will be a decrease in consumer demand. Any corresponding slowdown in order placement by retailers and brands in preparation for potential consumer reaction may have been a contributor to recent declines in fiber prices. Another potential reason, separate from demand destruction, that demand and prices have fallen in recent months is related to expectations on the supply side of the balance sheet. We have talked about how higher cotton prices can lead to higher levels of cotton production. Expectations regarding a record cotton harvest next crop year have led futures prices for delivery in 2011-2012 to be significantly lower than prices for delivery in 2010-2011. We can take a look at the effect of expectations for additional supply on prices using the futures market. Over the past several months, the most actively traded futures contracts for delivery in 2010-2011 have been those for May and July. Cotton harvesting in several major Northern Hemisphere producers accelerates in October and November, and the most actively traded contract for 2011-2012 delivery has been the December futures contract. Due to the expectations of record harvest in the fall, December futures prices have been trading significantly lower than prices for 2010-2011 delivery. On this slide, we can look directly at the effect of expectations of additional supply becoming available after this fall's harvest. The graph shows the difference in futures prices for delivery in 2010-2011 relative to December prices for delivery in 2011-2012. In March, prices for delivery in 2010-2011 were as much as 80 to 90 cents per pound higher than prices for delivery after the upcoming harvest. In more recent trading, the difference has narrowed to levels between 25 and 50 cents per pound. While the current difference in prices between crop years is smaller than it was a few months ago, it still represents a difference of 20 to 30% of current prices. Given the significant difference in prices for 2010-2011 and 2011-2012, there is a risk related to manufacturer inventories. Yarn and fabric prices have been responsive to changes in fiber prices throughout 2010-2011. If yarn and fabric prices are equally responsive with the expected decrease in fiber prices in 2011-2012, any inventories of yarn or fabric built from purchases of cotton at levels well over 200 cents per pound poses a real risk to profitability. As a result of this risk, there is incentive for manufacturers to delay orders in the short term and stretch existing supplies until the 2011-2012 harvest, or until the spread between crop years becomes less significant. This incentive to avoid inventory risk, along with demand destruction, could be reasons why demand and prices have fallen in recent months. All of this discussion related to demand is important because of its relevance to prices. The USDA is currently forecasting a 3% increase in cotton consumption in 2011-2012. Alongside their forecast for a 9% increase in production, this implies a 5 million bale addition to world ending stocks next crop year. While it is significant that the first addition to ending stocks in 6 years is forecast, there are developments that could threaten the current outlook. From the supply side of the balance sheet, there are some reasons for pessimism. Drought and flooding will likely affect the size of the U.S. crop. There have also been dry conditions in some Chinese growing regions. These factors could lower production estimates in coming months. The potential for a world harvest, several million bales smaller than currently projected, emphasizes the importance of questions on the demand side of the balance sheet. If the recent declines in demand and prices are a result of inventory risk, fiber purchases may pick up after the transition to new crop year prices is complete. Similarly, retailers and brands could be waiting to place orders to manufacturers until they're able to see how consumers react to higher apparel prices. Any such pent-up demand, at either the manufacturer or retailer level, could push prices higher in the fall, especially if the harvest is not as large as currently forecast. If the recent declines in demand and prices are more a result of demand destruction or a longer-term downward shift in cotton consumption due to higher cotton prices, upward pressure on prices could weaken in coming months. Over the next several months, the effect of the increases in cotton prices throughout the 2010-2011 crop year should start to surface at retail. Consumer reactions to these higher retail apparel prices will help answer our current questions regarding demand. As a result, retail sales figures will be important to track in coming months. Given the importance of these questions, Cotton Incorporated will be closely monitoring retail sales data and will continue to provide publications, presentations, and podcasts to communicate any of our findings. This concludes the current podcast. Any questions or comments are welcome. Please forward them to my email address. If you're interested in other market information, please visit our website at cottonlifestylemonitor.com. Thank you for your interest.